Today, we are talking about the one big, beautiful bill. Is your CPA talking to you about this? Is your financial advisor talking to you about this? We're bringing on Taylor Wolverton, our certified financial planner, as well as tax strategist, to walk through some of the nuances of the one big, beautiful bill that could go overlooked, and you definitely don't want to overlook them. Enjoy the show. We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in. Welcome back to the Secure Your Retirement podcast, and thanks for tuning in. I think we've got a very exciting episode for you today. Or maybe some would say it's exciting, especially our special guest, Taylor Wolverton, who you may know her voice at this point. You may know exactly what she does, which is everything tax for our firm. Taylor is a certified financial planner as well as an EA, which is an enrolled agent. So very well versed on individual tax as well as business tax, and helps our clients think through tax strategy, forward looking, as well as what can we do this year to make our tax lives a little bit better. So first off, Taylor, thank you for hopping in with me today to talk a little bit about tax.
Yeah, you're welcome. I am excited.
So yeah, I knew you should be excited. You as a listener, I don't know that you may be all that excited to talk about tax, but I think the topic today is rather important. We had the One Big Beautiful Bill Act that was passed a few months ago, and we're still uncovering and understanding all the different changes and what it means. And I think we're still going to continue to learn over the next year or so as far as how this gets applied. But from the perspective of, pre-retirement, in retirement, a lot of these changes do apply to you. We've done a couple episodes prior to this one, explaining some concepts that do apply to the individual. And so you definitely want to learn those and understand those, especially as we're going through the tax preparing process come next year. But today we wanted to take a few minutes to kind of walk you through some of the smaller provisions that I think could get overlooked but are rather impactful, and confirming some things for you as well. So Taylor, let's just dive in. Let's talk through a big one, which is the tax rates and this word permanent that's being thrown around. So, what was our risk gonna be if the bill didn't pass, and what do we get now?
Right. Yeah. So previously, before the One Big Beautiful Bill Act, the tax rates themselves were set to increase about 3% for each one. So, for example, the 12% bracket was going to go up to 15%. The 22% bracket was going to go up to 25%. Every single tax bracket was going to increase. So we might have said this in a previous episode, but I just wanted to be clear. A big part of this new bill is that the current tax rates, 10%, 12%, 22%, 24%, so on, are permanent. They are staying the same. What permanent means as far as tax law and Congress is using that word, don't know for sure. Of course, that could change in the future, I'm sure, but at least as far as we know, for the foreseeable future, current tax rates are staying the same.
Yeah, I was doing a speaking event last night actually, and we brought up the permanency of the tax rates, and I said, "Who here believes that permanent actually means permanent in the tax code?" And everyone raised, I mean, no one raised their hands
Yeah.
because it really just comes down to, well, who's going to be next in office and what do they want to attack? So what I think we can say is, well, there's, I think, significant opportunity ahead of us for the next few years of the whatever this permanency is to take advantage of these lower tax rates. So I would keep that in mind as you think through tax strategy. And if you don't have tax strategy, you should have someone that's helping you think through these numbers because there's a lot of opportunity right now. So that's good. Tax rates are staying at a bit of a discount for a period of time. Let's talk
Yes.
more now about estate tax and gift tax, and help, I guess, us understand first what estate tax is. That's ESTATE, by the way, not state tax, but estate. There's a lot of times people get confused around this, so
Yeah.
let's help listeners understand what it is first before we go into the changes here, or the lack thereof changes.
Yes. So after you pass away, all of your assets, those values are added up. Things like your home, your investment accounts, your retirement accounts, other property that you have, vehicles, jewelry, whatever other tangible assets, life insurance policies, things like that are all, those values are all totaled. If the value of those assets is greater than whatever the lifetime exemption amount is, which that dollar amount is determined every single year. If your total assets are greater than that, your estate has to pay tax on the amount greater than the exemption. So the current exemption amount has been made permanent along with the tax rates. So it's set at 15 million per person. If you're a married couple, that does double to 30 million. But what it was previously before the Big Beautiful Bill, it was going to be reset to about half of that amount. We were expecting if the bill did not go through, that the estate tax exemption would be more like 7 to 8 million, so cut in half. But that did not happen, and so now the current estate tax exemption, which again is 15 million per person, has also been made permanent. So what that means is after you pass away, if all of your assets are not greater than 15 million, you do not pay an estate tax. If it is greater than 15 million, that is when you would need to start paying an estate tax, which similar to current income tax rates is a progressive system. So depending on how much your assets exceed the exemption amount by, that determines what rate you pay. The top rate is 40%. So it can be an expensive part of your estate and something to keep in mind, but it is fortunate, at least with this bill, the higher exemption rate has been also made permanent. So,
Yeah, I think the big thing is that the 15 million is staying in place. So for 15 million or 30 million for a couple, most people are not going to be impacted by estate tax. But if you
yeah,
cut that in half and now it's seven per person or eight per person, now you're throwing in people into potentially being affected,
yeah,
and which requires a lot of thorough estate planning, and to avoid some of that taxation or think that through. So it's nice that it's a worry that most won't have to have, because it's staying in place. Okay, so
yes.
let's talk now about business and QBI, which stands for Qualified Business Income. Help us understand what that is first, and then what's going on with the One Big Beautiful Bill Act when it comes to QBI.
Yeah, so QBI applies when you have business income. So that could be self-employment. Sometimes even having rental income from real estate properties can count towards QBI. If you have just, other business income, maybe you're not like technically self-employed, but you have other business entities or structures set up, then that income obviously is reported on your tax return, but then you're allowed up to a 20% deduction on that amount of qualified business income. And there are limitations around how that works and some income limitations. You may not qualify for the full 20% deduction itself, but what was previously slated to occur was that QBI was going to be further limited or possibly even removed altogether, depending on what Congress decided. And so that's another piece of the Big Beautiful Bill, just to be aware of that QBI is here to stay for the foreseeable future. That's also been made quote unquote permanent. So that will continue for those that are self-employed or potentially have rental income, that continues to reduce the amount of tax that you are liable for on those types of income.
Nice. So another positive deduction that is staying in
Yes.
place for
Mhm.
anyone that's self-employed or running a business. So that's good. Charitable giving. This is something that we talk with clients all the time, and our opinion, by the way, to anyone listening, is really, we could, I'll say it bluntly, we could care less whether you give or not. But if you are giving, we want to make sure that we're doing it in the most tax effective manner, so that your wishes of giving is taken care of, but as well we get some benefits. And so traditionally, it's been a little bit hard to get those benefits on charitable giving. And there are some strategies outside of the One Big Beautiful Bill that we've talked about all the time around qualified charitable distributions and donor advised funds. But with the One Big Beautiful Bill, charitable giving has changed a little bit in a positive way, I would say. So Taylor, let's walk through that one because I think everyone it really would want to know about this, even if they are taking the standard deduction.
Right. So historically, in order to benefit from a tax perspective from donating to charity, you have to itemize your deductions, which means you have to add up all those expenses that qualify for itemized deductions. That has to be greater than the standard deduction. Otherwise, there really is no benefit coming through to you for donating to charity as far as reducing your tax that you're paying. However, this new bill has introduced a change to that starting in 2026, where even if you take the standard deduction, now on top of the standard deduction, you can qualify for an additional charitable deduction. If you're filing single, it's another $1,000 deduction. If you're filing jointly, it's another $2,000 deduction for charitable donations. That does have to be a cash donation, so it can't be donating tangible items to Goodwill or donating stock even will not qualify for that. It does have to be a cash donation, but that is now on top of the standard deduction, which is not typical and is a new change for 2026 going forward.
Yeah, I think that's a nice one. It wasn't available and now it is, and you don't have to itemize to get access. I mean, that's all good stuff.
Yeah,
And, most are giving, I would think, somewhere around that and not getting any benefit for it. So,
yep,
it's a nice addition. Let's talk about the Trump accounts. There's been talk about them. There's a lot of unknowing as to how they're going to work and how they operate, but it's been this
yeah.
nice little promise of, being able to fund these accounts and getting a nice benefit from them too. So I'll say this: this is an evolving topic. So,
Yeah.
Taylor, tell us what you know about it so far. Obviously, realizing that next year we'll it may change or we'll learn more and we'll have more details, but take us through what you know so far.
Yes. So for children born from January 1st of 2025 through December 31st of 2028, they're eligible to open what right now is being called a Trump account. The government will contribute $1,000 to those Trump accounts. And then for other family members, parents, grandparents, whoever else, if they also want to contribute on top of that $1,000 government seed money, then that is allowed up to $5,000 per account, per child each year. So I mean, at a minimum, if there's a baby born between those years, get the account open to get $1,000 of that seed money. And then if it benefits your situation and you want to continue adding to that account, that is possible. It does have to be invested in a fund that tracks the S&P 500. And no withdrawals are allowed until the child that the account is in the name of, they have to be at least 18 years old before any withdrawals can take place. So could be potentially beneficial for those that are eligible. Yes, we are still waiting for more information to come out on exactly how all those rules work, and some of the taxation is a little bit unclear when those withdrawals do take place. How does the tax get paid on what dollars? And some of that's a little bit fuzzy still. Also, these accounts can't even be opened until at least after July of 2026. So it's not something that can be started right away, but after July of 2026, even for children born in 2025, those accounts can be opened. So yeah, at least something to be aware of if you have a grandchild or a child born in those years.
Yeah, and I think as we get more clarity, we'll probably provide that on this podcast down the road in
Yeah,
2026.
and
But
we'll talk again.
because it is a nice little addition for a parent or a grandparent to be able to set up a newborn. But there are specific rules. So okay. I think there's one other big one that we wanted to talk about, something that has
Mhm.
not been available before. And so I actually learned a lot in this pre-conversation that Taylor and I had about car loan interest and how that works in the tax world. So take us through that as far as what's the new benefit here.
Yeah, historically, car loan interest is not deductible. You don't get any tax benefit for having an auto loan, period. But now, starting for the tax year 2025, so this could be reported on your 2025 tax return through 2028, there are some certain requirements that need to be met, but it is a possibility to deduct your auto loan interest. So some of those requirements that is important to be aware of is first thing, it has to be a new car. So not used. This does need to be a new car. And then the final assembly of the car does have to take place in the United States. And then the deduction is allowed up to $10,000 in interest. And that deduction is available regardless of whether you itemize or take the standard deduction on your tax return. And there are some income limitations as well. The $10,000 deduction does start to phase out. If you're filing single, once your income exceeds $100,000, the $10,000 amount is reduced. If you're filing jointly, that income limit is $200,000. So, depending on your situation, you might not get the full benefit amount, but still, if there is any amount you can deduct at all, that's more than what has been available historically. So if the loan is through a credit union or whoever the loan happens to be through, that custodian is who is supposed to issue a tax form reporting that interest. That might not happen for 2025 since it is a new provision. So if you're preparing your own tax return, you might need to go look up your own records to figure out how much auto loan interest you've paid this year if you're otherwise eligible. But going forward, that is how the reporting is supposed to work.
Yeah, so I think that's huge. I mean, when I was talking with Taylor, I said, so this will just make it easier for someone to go into itemized deductions. And she said, no, this is on top of the standard deduction. So
Yeah.
that right there is power in itself. If you have a new car and you're paying interest, it is a tremendous, I think, tax benefit there. But you got to know about it and you got to know how to report it properly. So this all kind
Yep.
of leads back into this idea of tax strategy that, we've taken our firm into this direction years ago, and we've seen tremendous benefit on our client side as far as them understanding their tax bill and running tax strategies. And now, in a environment that we're in right now with tax law change, Taylor's able to kind of work through that and help people understand and see what their new benefits are or potential new opportunities they have for tax planning. So if you've got questions, and you listen to this and you're like, my CPA doesn't talk to me about these things, and you want to understand what our program is all about, and when it comes to financial planning and tax strategy, we are always happy to have that conversation. And so the easiest way to do that is hop over to the website, pomwealth.net. And from there, you'll be able to click on a link that will schedule a 15-minute phone call. You'll speak with one of our advisors, and from there, we'll pretty much determine is there value that we can add, and we'll show you how. And if not, we'll give you guidance at the very least. And it always ends up being a very nice conversation. So if you wanted to do that, we're always happy to have those conversations. But with that said, Taylor, thank you so much for your time, and thank you for doing this research for this podcast. It's going to be very valuable to everyone out there.
Yeah, of course.
All right. Well, everyone, have a great day. Thanks for tuning in, and we'll talk to you again next Monday.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.